any housekeeping we need to do, Ken, or if we just simply go into the next phase?
I think we're ready to go into the next phase, Mark.
Is Cy able to join us?
Cy is here, and I'd like to introduce our guests. We have guests from all over the country tonight to keep you enthralled, and we have some of our directors helping us out tonight with presentations. I'm going to start with the prettiest of the group, and that's Charlene Hansen. Charlene is from up north near Traverse City, a beautiful little town called Elk Rapids. She's the former president of one of our model clubs up there called the Port of Value Model Club. And Charlene will be presenting a stock tonight, Ensign Group. She's very excited about that stock, so I'm looking forward to hearing from her. We have one of the original Knights of the Round Table with us from Atlanta, Georgia, Cy Lynch. And Cy is here tonight. I think Cy is going to present Globus Medical. Am I correct, Cy?
You're correct, Ken.
I am correct. Okay. And you get those dulcet southern tones from our original Knight of the Round Table, Cy Lynch. Coming from the Maryland area, the Washington, D.C. area, is Kevin Galagli. Kevin's been a real great help to us in the last year and a half, filling in whenever we've needed an extra voice. And we're happy to have Kevin with us this evening. And Kevin's going to be presenting a stock that was beaten down pretty much and is starting to stage a comeback, and that's ResMed. So I look forward to hearing what he has to say about it. I'm going to be producing and directing a presentation on Shockwave Medical. And I'm really kind of excited about this particular stock. And then Mark is going to do a song and dance, and I'm not quite sure what he's going to sing and dance about. So we'll have to hold our breaths and see what he has to say. But
as long as Portillo's is not part of the equation.
Well, I thought Kevin was presenting Portillo, so I was just getting out of his way.
Okay, enough, gentlemen. All right. So without further ado, let's begin the presentations. And we have our disclaimer here. First of all, everything we say or do is for educational purposes. If we own a stock, we'll try to tell you that we own it on our own portfolios. If you're brand new to the roundtable and did not receive a reminder about the roundtable, but rather got your link from a friend, you can be added to our reminder list by dropping an email to annakavula1@comcast.net. That's my wife, and she'll get you onto our guest list. And then you'll get one reminder a month about the roundtable. It'll include a link for helping you register. And then once you register, you'll be getting some links for actually joining the presentation. If you'd like copies of the slides from tonight, you can directly email Mark, or if you have questions about tonight, Mark's email address is down there at the bottom, and so is mine. We relish questions. Just remember that we're both volunteers, and we'll get to them just as soon as we possibly can. But the elder volunteer, that's me, is doing a fair amount of traveling, and I'm feeling really good about not having to spend 2 or 3 hours a day on better investing every day of the week. So drop me a question and I'll answer it when I get a chance. Okay, let's get moving here. Here's our performance. And notice that in the last month, we've moved above the red line again. The red dotted line signifies approximately 5 points above the market. And that's been our goal since the inception of the roundtable. We're in our 13th year now of the roundtable, and we've moved above with relative return at 5.2%. Relative return is nothing more than the rate of return of the entire portfolio. And this is a tracking portfolio. It's not meant to show you how to manage a club portfolio. It's a tracking portfolio. And its rate return has been 14.6% over inception, the time since inception. And the Wilshire 5000 during that same period of time has returned about 9.4%. So you take one and minus the other and you get that 5.2. That's how much we're beating the benchmark by. We try to stay above 5 points because that's what we think was taught by Better Investing way back when it began. They didn't have computers. They didn't have a lot of ways to do these calculations real quickly. So George Nicholson said, you know, the market does about 10% a year. I think we can do 15. Let's aim at that plus 5. And let's say that 15 is a great goal over long periods of time. That's exactly what we're trying to do. We'd love to see 15, and we're not too far away from it right now. I think I got everything on the slide, Mark, okay? We have looked at the most widely held stocks in the manifest dashboards that exist on manifest investing, and we've come up with our own magnificent 7, and we've shown you the relative return since the date that they made that most widely held list. And the Magnificent 7 overlap quite a bit with the Magnificent 7 that they talk about in the stock market. But Cognizant and Visa and Fastenal have replaced 3 of the stocks in that other list. You know, you can do a heck of a lot worse than owning just these 7 stocks for the last 20 years plus. You'd probably be a very, very happy camper. Remember, that last column, folks, is relative return. If you want to see total return, you have to go in 3 columns. Total return is right there. And those are pretty amazing numbers, especially the first 5 for any stock at any time. Those are annualized returns over, except for Visa, exceedingly long periods of time. And even Visa is a 15-year return.
Magnificent. That was magnificent, Kevin.
Here's our roundtable top 20.
Finally.
Here's our roundtable top 20, folks. The tracking portfolio contains 100 plus different stocks that we've chosen. We do take them out of the portfolio. We kind of freeze them when we feel they're no longer good ideas, but we add to them. The largest holding by far is Microsoft. That comes from an original $5,000. So over the period of the roundtable, we've put in $5,000. How do I know that? Well, I'm reading up in the legend up there, and I see 5 times. Each time is a $1,000 investment, and Microsoft is in that $1,000 category. 5,000 has grown to 85,000 plus. It's kind of running the portfolio at the moment, but you can notice that there's quite a few at the top of the list here, our top 20. Some of these are only one-time investments. I go down the list to Costco. That's only a one-time investment, and for that one investment, it's now worth $11,500 plus. The only regret is that we didn't choose Costco more than one time when it was in the buy zone. A lot of great companies on the list. Mark, do any of them jump out to you?
Well, Ardelyx has made a nice recovery here lately, helping me out a lot. No, same story as always. Those Magnificent 7 companies, as characterized by the pundits on television. Amazon is one of them. Amazon is a 2-time selection by Hugh McManus that is now, so $2,000 has become 18. So it just shows the power. And then I would point out, you know, I picked Globant for the best small companies. One of the reasons I chose it is it's one of the few companies that Cy Lynch has not picked that are in that realm. Because, you know, he's got Cognizant, he's got EPAM, I think probably a little Maximus in there. You know, if it's in information technology and in management consulting. Cy is following it and probably owning a whole bunch of it.
I just sit and watch Cy and pay very close attention whenever he tells me something that I should be interested in. Cy was the one that introduced us to EPAM, and before the war, it was doing extremely well. But you can see, even with the disruption in Ukraine, the war in Ukraine, that EPAM has come back now to almost double since we started buying it. I think it's been purchased 7 times. Yes, I'm right. 7 times up there is EPAM. So all in all, you can get the entire list of the roundtable holdings by using that public link right up there. That's an absolutely free link. Go to manifestinvesting.com and then ask for dashboards. So it's /dashboards, plural, and then / once more to public and / once more to round table, and the word is hyphenated. Put that in there and you'll get the public link of all the holdings. If you're a Manifest subscriber, then you can just click on the link on the opening page of Manifest, and it'll take you directly to this particular portfolio.
And with that, Ken, we really don't have any companies on the hot seat. We tend, as a community, to avoid thinking about selling stocks. There's a little bit of tax-related selling considerations going on right now, but when the market is down like it has been for the last 2 months, we're shopping to buy, not necessarily doing a whole lot of looking to sell. So it's an interesting time. So if we're clear of this, we'll get started with our stock presentations. What do you think?
I'm just going to alert you to one thing, Mark. Somebody in our audience is telling me that Portillo's has announced they're going to open a store near Atlanta. So you have another place to travel to get Portillo's now, okay?
Excellent. Excellent.
Yeah, I think Whataburger has made an appearance in the Atlanta area too. So, we must have arrived.
Atlanta is a destination and a half, that's for sure.
Portillo's and Whataburger, yeah.
All right, so with that, I think we can switch to our stock presentations and Charlene and Ensign Group.
Hi, everyone, and I'm excited to present Ensign Group tonight. Let me first make a disclosure. The club that I belong to, Portvalue, purchased some of this company in June of this year, and we've been glad that we did. Ensign is a skilled nursing, senior living, and rehabilitative service in the United States. They provide healthcare services in post-acute care, urgent care centers, and mobile ancillary businesses in the United States. It's a medium-sized company, founded in 1999 and headquartered in California. The Chief Executive Officer, Barry Port, concurrently serves as a member of the Board of Directors since May of 2019. He's been with the Ensign Group in several positions since 2004. But he's young enough at 45 to continue to lead this company for several more years. Next slide, please. The operating subsidiaries offer other post-acute related services, including mobile X-ray, lab, non-emergency transportation services across several states. The nursing facilities include specialty care, such as on-site dialysis, ventilator care, cardiac and pulmonary management, special nutritional programs, social services, recreational activities, and several other. And you've already moved on to the SSG. I pointed out some things here that I really like about this company. First of all, starting with those up straight and pretty parallel lines. The analyst projections for the company are in double digits, and you can see from their history down below that they've had very strong growth in both earnings and in revenue. The projections for this company, and you can see that by the red arrow over there, shows that the analysts are expecting 15% both sales and earnings. I like it that the shares outstanding have remained constant over the last several years. And when you look at your own SSG, you'll see that line's been pretty straight. And this year's stock price fluctuation has been fairly small. It's a low of 85 to a high of $104. The current price is around 97 right now. Down below where the fundamental company data is, I highlighted the last 3 years in yellow because you can see that the growth has been really strong, and both revenue and earnings have grown at 21%. That's a great indicator that growth is sustainable. Pre-tax profit has steadily grown and more than doubled since 2019. And you can see that little red squiggly line at the bottom shows that positive improvement. The 21.8% in pre-tax profits is actually at industry average right now. The third quarter was just reported last Friday on October 26th, and that's highlighted in yellow up at the right-hand corner of your chart there. Revenue was positive 22%, and earnings were up 12%, and that beat analyst expectations. The company increased 2023 earnings guidance to from $4.56 up to somewhere between $4.73 and $4.79. So investors like that, and the stock price on Friday jumped $2 after they reported their earnings. Next slide, please. There was an area of concern, and that is when I saw the debt being at 55% and averaging at 53%. However, the industry average for this kind of a business is 74%. And when I looked at their balance sheet, found that the almost 40% or a little over 40% of their debt is in long-term leases, which the IRS now makes companies report as debt. Ensign's executive vice president and chief financial officer also reported that the company's liquidity remains strong with approximately $468 million of cash on hand and $593 million available capacity under its line of credit. And that was from their third quarter report. Next slide, please. When I projected high and low prices, I always refer to the price earnings ratio. Things to note here in the red squiggly shows that the current PE is 22 compared to the average high of 26 after I took out the outliers. And if you look at the one highlighted in yellow, the 5-year average at 22, and you see that the current PE is right at the 5-year average. I put a star by the 24, the trailing 12 months, because I use that in my projection to come up with a high price. So if you go to the next page, Mark, my projection put the high price at $190, and I use the average low PE to get the low price, which came to $65. You can go to the next slide, please. So with my projections and forecasts, and of course you want to do your own and dig as deep as you think you need to, but it shows, I came up with a average compound return of between 12 and 15 or almost 16%. You compare that to Mark's manifest numbers, which gives a par of 14.2%, which is listed right underneath that chart. So that makes me feel comfortable that my projections were, are fairly close to what Mark is coming up with. So that makes me comfortable. The quality of this company is excellent. 5. My high price projection was 190, and manifest investing high price average is 185, or forward price. Simply Wall Street reports the Ensign as 25% below their estimated fair value. Next chart, please. Looking at manifest graph for this company, again, things I liked, the quality in this company has been really consistent since March of 2021. And it was even higher than that back earlier on until COVID hit and it had that drop. So the 95 and being consistent is good, and the 14% on par. So it's kind of ranged between 14 and 16% also since 2021. So I like that consistency. Next slide, please. The Ensign Group this year bought operations of nursing facilities in Kansas City, South Carolina, Washington, and Colorado. The latest deal increased their portfolio to encompass 296 healthcare operations spanning 13 states. Of the total, 26 also have senior living operations, and the company now owns 112 real estate properties. Ensign continues to pursue opportunities to purchase real estate and lease both successful as well as struggling skilled nursing, senior living, and other healthcare related operations across the country. Its proficiency in acquiring real estate and or leasing post-acute care operations and subsequently turning them into industry leaders plays a pivotal role in enhancing its profitability. The primary advantage of outpatient clinics is cost effectiveness. Outpatient medical care clinics do not retain patients for long hours or overnight or charge exorbitantly. Financial incentives like health plans and government program payment policies supporting services in lower cost care settings have also been driving outpatient care. So this concludes my introduction to a company that appears to have very, very good growth potential. Thank you for listening.
Shar, could you repeat your sales growth forecast and your earnings growth forecast for one of our viewers?
Okay, I did, let's see, I did not fill them in because I thought people might want to look at their own. I'll kind of go from memory when I think our projections were less than what you see the analysts. I think we did 12 on sales, and I don't remember the number that we picked for earnings forecast.
It's not that important. Thank you, Shar. We have a question, a hand being raised, so I'm going to unmute Phil. Phil, you have to unmute yourself if you want to ask your question. Phil Sidor, if you have a question, you'll need to unmute yourself. Okay, that was an inadvertent hand. I have another hand in the air from Kate Smith. And Kate, you'll have to unmute yourself as well if you want to ask your question. And again, that disappeared, so it must have been another inadvertent hand. So thank you, Charlene. Really, really nice presentation. And let's move on to whoever's next, Mark.
Yeah, and Charlene, I would point out that you bring a smile to the face of Ken and me. Ensign Group was one of the best performing, best small companies just a few years ago.
Oh, I think it's going to be again. They're really progressive.
All right, next up is Cy with his reinforcement of Ken's selection of Globus Medical.
Yes, and I'll just point out, Ken mentioned earlier about liking things on sale, and maybe last month he pointed out Globus on sale, but you can see on this chart, it's sitting right around the 52-week low. In fact, notice it is fairly close to, the 2019 or so, a 4 or 5 year low, with the exception of the 2020 COVID year. Notice the high prices have been relatively flat to down for the last 3 years, but notice sales and earnings have been growing significantly during that time. All of those factors, without digging in a lot deeper, tell me that this could be a potential good opportunity to buy. You'll see if you really look at the PE ratios historically, the company probably got a little bit ahead of itself, perhaps because of that explosive growth coming out of 2020 that you see. The market got a little overexcited, but it certainly appears to be reasonably valued now based just on what's in front of you. Let's keep on moving. I came up with Globus. It had appeared on some screens that I've looked at, I think even for the growth stock outlook column in the magazine and some other portfolios that I am part of. And so I've been kind of looking at it. When I saw that Ken and Mark were doing small company favorites today, I said, well, let me do a screen of manifest definition small growth, small companies, that being 12% growth or higher. And this is what I came up with excellent quality, par, a little below the MyPar +5 goal, just to expand the market a bit, and good financial strength as well. And you can see Globus came in right at the top of the non-yellow companies, as you see, in excellent quality. Next slide. Ranking by quality, came in third. Again, highest earnings among that, with the exception there of MP Materials. So that's how I came up with Globus, and then noticed that it had been picked last month as well. It looks good in the roundtable portfolio if you were looking to do a repeat selection. But this is how I came up with it. Next slide. Just a quick review on what it is. Globus Medical is a medical device company and works primarily in the orthopedic and specifically the spinal areas of the Globus Medical. We're going to see in a moment, as Ken mentioned last week or last month too, it has merged with a competitor, NuVasive, and over doubled in size. But Globus, more than half the revenues came from the United States. Remember that when we look at the post-merger company. Next slide. Two basic categories, musculoskeletal solutions, that's the orthopedic and spinal hardware, if you will. And then they are also developing computer systems and software to support their hardware solutions. There you go, Mark. I've had to get IT somewhere into this tonight. Next slide. There's no debt. You can see again, these figures are the Globus pre-merger with NuVasive. And you could see they've had a historical mid-20 to low 30 profit margins on sales, and have averaged 22 over the last 5 years, are up to about 24 now. And there's certainly some potential to expand just looking at Globus. Next slide. I went ahead and said, here are my judgments based on the historical Globus data, which is what we have. I actually looked trying to find pro forma, and apparently they have not yet produced pro forma. Their last discussion, they mentioned it in the prospectus, and then they put out a UCC Form 8 filing saying that they would, within the next 75 days after the merger, which was September the 1st, would be putting out required financial data, which should include the combined company pro formas, and also their earnings report, which I believe is November 6th or 7th. They also plan to discuss the impacts of the merger in the first couple of months. But here are my judgments. About a 12% sales growth rate. That's a little higher than the 10-year average, but it's in line with their recent years' growth. Notice I did expand the pre-tax profit margin a little bit to 24, which when you saw from that history is certainly reasonable, and come up with 356 per share earnings per share 5 years out. That's a bit below the manifest consensus. Next slide. Those judgments lead me to a potential 20.8% return using the high PE forecast, and 17.8 using the average PE compared with the manifest par of 21.3. So now let's talk about the new company a little bit. I would say this is a strong addition to the portfolio as is. But here's Globus Medical, the new company, how they say here have joined forces, uniting to advance patient care. Next slide. Here's just the management view of what the combination offers. Notice the upper left-hand corner, a complementary global footprint. NuVasive brings much more foreign business to the company, expanding the global reach of the company. Next slide. Here's just a history from the company's merger presentation. I believe this was in Ken's presentation last week. You could see the top, or last month, the top line, the purple, that's the NuVasive sales growth, and some pictures of their devices over time. And then you see underneath the Globus in the aqua line and some of their hardware that came out at various times. Next slide. Here is the map that shows you where the blue being Globus, largely concentrated in North America and the United States. NuVasive having United States as well as some Southern Hemisphere and European exposure, with a little bit of smattering in South Asia. Brings 50 countries into the fold. Next slide. This is just a picture, if you will, of how comprehensive the spinal portfolio is. This is, you could see again using the aqua and the purple, how blending the companies together, they have pretty much covered the spinal market. Next slide. Then you get into the more general orthopedic. Most of this was already in Globus, but you see NuVasive brings some too. But the new company seeks to be comprehensive in both orthopedic as well as spinal specialized. Next slide. And here's what the company says about the merger when it comes to investors. Again, they reinforce the strong profit margin expansion potential that I'd already noticed and mentioned. They're saying mid-30s EBITDA by year 3. That's versus the high 20s now. Notice they're expecting to exceed market growth by mid to high single digits, cost synergies, and accretive to non-GAAP earnings per share from year 1. We'll have to wait and see exactly what their non-GAAP adjustments are, but what that generally means is excluding merger-related costs, they'll be accretive to earnings in the first year. Next slide. This is what analysts say about it. Morningstar finds it as undervalued, 36% discount to fair value. 5-star price is up to 51, and the price, I guess, yesterday was 45.71. My price was 45.36 or somewhere in there, same basic price, but well below the 5-star price. Next slide. Value line, and this is the pre-merger company. 18-month target 65%, and annual total return projection between 13 and 26, which is well reaffirming. In fact, it actually brackets on both the low side and the high side my projections and manifest projections. Next slide, which should again be my projections comparing manifest. Again, I think that tripling and quadrupling down on Globus is an excellent opportunity for us to look at what was a high quality, well-positioned company and likely is even better now.
Thanks, Si.
Thanks, Si. We do have a hand in the air, and I'm going to unmute Kate Smith. Kate, you are muted on your end. You'll have to unmute yourself if you want to ask your question. And the hand went down, so I'm going to assume that's an inadvertent hand. So let's continue on to our next. Wait, Kate's hand is back up again. Kate, you have a little microphone icon on your.
Yes.
There we go. Okay. What's your question, Kate?
I'm sorry, Ken. Thank you. I wanted to ask Si if how many people this company employs worldwide. And
I'm sorry, I don't know the answer to that question. I can find that out and get it out to you.
well, and it sounds like you're anticipating the growth to move along briskly. Do you see that being affected at all with the current situation regarding supply chains and moving or getting stymied with the activity in the Ukraine and in Israel?
Well, certainly anything like that is possible. I'm not aware that either the pre-merger Globus or the post-merger Globus are particularly beholden to either of those areas. Of course, Israel is a new issue, but notice if you think back to the very first slide, quite explosive growth in 2021, 2022, and into 2023. And of course, much of that overlaps the Ukraine situation as well as the post-COVID supply chain. So certainly anything's possible, but they seem to be managing supply chain issues pretty well right now.
And Si, I have one more hand in the air. It's Kay Berg. And Kay, you are self-muted. You'll have to unmute yourself if you want to ask your question. Kay, you'll have to unmute yourself. All right, we're going to assume that's an inadvertent hand. And one last question from Beverly Hornecki. Beverly, you are unmuted. Go ahead with your question.
Okay, thank you, Ken. And by the way, it's Bev Hornicle.
Hornicle. Okay, I'm sorry.
Good try. Good try. I noticed, Si, that the price has really fallen down most of the year. So what do you attribute that for? And I don't think I heard you mention that.
I did not actually mention it. I almost alluded to it in my talking about analysts. The primary attribution to the price drop that I have seen from analysts, and it tends to track the announcements, was that the market feared that they overpaid for the company. It was largely, well, I should amend that. That's one thing, that they overpaid for the merger. That's one concern. But if you believe the company, they say at least it should be accretive to earnings, and as long as it's a solid combination, the overpayment should take care of itself. Also, Value Line hit them pretty hard in their last report which was dated in August, which is pre-merger, and Value Line was hitting them because there was some concern that the U.S. FDA might sue to prevent the merger, as well as, I believe, some European regulators. Of course, that did not take place either. Now, of course, that can't fully explain today's price because the merger has taken place. But the best answer I've come up with from looking at analysts and just looking at the news and the timing is that the market doesn't particularly like the merger. And I'll be honest, I'm not sure I understand that, especially post-merger. I understand the pre-merger concern, but now that it's happened, do you have any views, Ken?
Yeah, Cy, the only thing that I could find in addition to what you've already said is that the entire medical device industry has not been very robust this entire year. So this stock has moved in concert with the entire industry. So you add that to the concerns about the merger and the concerns about regulation, and you get a very low stock price, which I view as an opportunity.
Yep. Thank you for that.
Okay, we're going to continue, and we'll try to fit questions in as we go, but let's continue with ResMed, and this is Kevin Galagli, our friend from the Washington-Baltimore area. Kevin, go ahead.
Hello, everyone. My name's Kevin Galogli, and yes, this is a presentation I did a couple weeks ago at for my model club, or the model club I'm part of, the Montgomery County Model Investment Club in Maryland. Mark, just to check, you didn't update. This is the one I sent you a couple weeks ago, and not the one that I sent you at 5. No, you got it. Okay, great. Well, here it is. I wanted to be able to let you know that this slide is being sponsored by the hot dogs of the Columbus Clippers. And I'm getting a nice little kickback from it. But one of the things is that, the 3 people in there, if you can't really tell, that's Mark on the left, that's Ken in the center, and that's me over on the right, because I'm all full of mustard. Anyway, so here's the screen from over on Manifest, and I decided let's look at the triple play. And I like to only have like 2 or 3 metrics in there, and Cy did the same here. So I end up having a Manifest rank of 95, a nice good sales growth of 10, and then a core score of 225. And as you see, I got, I think, 13 of them in here. Some of them, we just talked about Globus. We see Taiwan Semiconductor, and then Kim Butcher's favorite, PayPal. And there's even Bank of the Ozarks and XLS Services. So when I see something like this, it means I'm sort of traveling in the right company. So let's go to the next slide. And so here's what ResMed does, is that they focus on medical devices, including sleep apnea and COPD. The first CPAP machine, which is what's used for sleep apnea, was invented by a doctor who also tinkered from Australia, and in 1980. And he only had this one patent. He gave it to some investors in 89. I don't know what equity interest he remained with. Within a year, they moved from Australia to San Diego, and then eventually became part of the S&P 500. And if you look at this, the devices is about half of their revenue, and that includes both the ones for sleep apnea and COPD. Most of the device revenue is really from sleep apnea. But the other thing is that those accessories, what happens is they make a lot of products, for the accessories, and they make them proprietary. They end up creating a lot of different patents so that they fit better with their devices. People can use any ones that they want to, but the thing is that gives them sort of a little bit of a moat and protects themselves with some of their things. So say, look, this tubing works better with this particular device. And then the third thing down there is that subscription, SaaS is subscription as a service, sort of like, if you have Adobe and you have a subscription or what have you. They acquired a company a couple of years ago that sort of helps them in terms of developing that. I think they were from Germany, and that's a lot of the Bluetooth. So in other words, you download a lot of the information, that goes onto your phone. You can share it with your medical professional and take a look at it. Let's go to the next slide. So this is a triple play as a possibility. And, we love to be able to see a triple play. And we've talked about it at the bull session several times. But the thing is that, it's great. You can see you have a depressed stock price, increased margins, and maybe that PE ratio is going to expand. At the end here, the quote talks about the end of a long bear market. Now, we haven't been in the end of a long bear market. But the thing is that we are sort of in this area where it's really been beaten down. So let's go to the next slide.
I would argue that medical devices have been in a bear.
Yeah. So you can see the triple play visually on the front side of the SSG. I don't take you through it here. So if you take a look at this, and we showed this again with Globus and a couple other stocks, is that when you see that 52-week, where the current price is down near the 52-week low, anytime I see that on a stock, and it's a good quality stock, and this one again, it's screening parameters, good quality, a core score 225 or better, these lines up straight and parallel, those are good lines. This is something to clearly take a look at. The second one, the higher profit margins, you can see in two, really from 2020, it's had steadily increasing profit margins. And we talked about this before, is when you see either the magenta or the earnings line moving closer to the sales line, that's a good sign. Now, that's not a massive increase in the pre-tax profit margin, but it is an increase, and that's something to take a look at. The third one is that if you look at the price bars and compare to the earnings line, is that when that earnings line crosses the price bar, that's when the PE is 10. If the price bar is above the earnings, it's greater than 10. And if the price bar is below the earnings, it's less than 10. So you can see right away visually, this is a stock that sells at a premium because those numbers are significantly above. But if you look at line year 2024, they're already into fiscal year 2024, is that price bar has dropped closer to the earnings, which means it could be a buying opportunity. Next slide. So when you see something like this, my first thought process is, what am I missing? Is this, not just a great triple play? Is it a value trap? Am I going to be catching a falling knife? And I'm going to start in the bottom and work counterclockwise. So ResMed is down 33% over the past year. Year to date, it's down 29%. Okay, now, so what's causing all this? You look at Barron's, and this generally the stuff I found was just talking about intraday stuff and how healthcare is, and as Mark just said, the entire medical device industry seems to be really taking a beating. So, okay, that's not really it. Up in the upper right, that's from ResMed's website, and that's talking about one of their competitors, Philips. They had a recall because some of the foam on their CPAP machines was breaking up, and so they've pulled out of the U.S. market for a couple years. They're supposed to come back at the end of this year, early next year. And so that's not really causing it. In the middle, in the orange, that's medical equipment. There was a talk of kickbacks, and they had a whistleblower, and they had to pay $40 million. I think that was in Asia. I can't remember. So the final one is Motley Fool from September, 2 months ago, over on the left. And that one, the ResMed CEO says Ozempic and Wegovy, two drugs owned by Novo Nordisk, has had some impact in terms of weight loss. And the thought is that this weight loss will be able to mean that people, if they lose weight, they're going to not necessarily need a CPAP machine to do it. That hyperlink there that I have there on the weight loss is from the ResMed site. And they say that they don't think that weight loss is going to lead to people stop using the CPAP machine. There's still enough demand. So it could be just that whole thing of Ozempic and Wegovy. Maybe there's some other things. So let's go to the next slide. So here it is. This is a total addressable market. I usually like to look at this for a company. And if you get the slides, these are all hyperlinks, but this comes from a site called Grandview Research. And if you see in the upper right, this is the U.S. sleep apnea market, and they're showing that it's going to be growing through 2030 at 5.5% of the market. The globally, they're talking about it being a 6.2%, and that they think that the entire market will be almost $7 billion. Now, ResMed has annual sales of just over $4 billion. half of it is in devices, and some of that is really in COPD. So you're really looking at ResMed probably has about $2 billion of their money in there. So there's an opportunity for them to be able to take more of that market. And where's it going? It's going into the fastest growing market there in really in Southeast Asia. You could take out, 4 of the 5 largest countries in the world by population are in that fastest growing market. It's China, India, Indonesia, and Pakistan. Only US is the other one in the top 5. So there's a great opportunity there. Let's go to the next slide. And so here again, this comes from a German company, Statistica, and you can take a look at this. This is the annual sales for devices from 2017 in the projections. In 2020, the Americas, North and South America, is about $2 billion, the entire market, not ResMed. And it's growing. They project in 2023 or 2027 that this is going to grow by 33%. Oh, I forgot to mention, this page is sponsored by Joey the Jaws Chestnut, the 16-time champion of Nathan's hot dog eating contest. So we're having a lot of sponsorship. Since we didn't take Portillo's, we have to be able to keep it in here. If you go up into the top, I'm going to skip up into the Asia and Pacific. If you see in 2020, they're at 988 million, and they're projected to go to 1,659. That's about I think that's a 2/3 increase. And then in Middle East and Africa, that's a 40% increase. So you can see that there's a lot of opportunity outside of the US for this, because again, as ResMed talks about, is that they have over 1 billion people have sleep apnea, and 85% of them are undiagnosed. Next slide. And so here's some of the competitors. The problem with ResMed, if you're looking at it on the SSG, is that their best competitors are not American companies. And again, the CPAP machine is continuous positive airway pressure. ResMed leads the market. They're somewhere between 40 and 45%. Overall, the 3 largest ones, Philips, as well as Fisher Paykel, which is a New Zealand company, they take low 70s and the like. And again, ResMed seems to be holding them off pretty well with innovation as well as good services. But if you look at this overall, it's kind of hard to do it. Philips is really their machine is really part of a subsidiary. I think Philips is a Dutch company, and Fisher Paykel is a New Zealand company. So it's a little hard to do direct competitors with them. Anyway, next slide. And so here's some other stuff on ResMed. So the Mick Farrell took over from his dad in 2013. They have a great capital allocation. A narrow moat, some people sort of steer away from that. Narrow moat means they still have like a 10-year advantage, whereas a wide moat is a 20-year advantage. And since that one initial patent, they now have 6,000 of them globally. In the lower right-hand corner, that stuff from the ResMed website that talks about, some of the healthcare technologies. That's the reason I'm surprised that Cy didn't take this, because it has technology in it. But if you look at some of these other things, they seem to be pretty responsive. Over in the lower left-hand side, you see the capital deployed, and this comes from their presentation, and you can see that they are reinvesting their capital 30% in R&D. That's about 8 or 9% of their annual sales is going into R&D. The merger and acquisitions, I think that's just really the rollout of one big acquisition they had a couple years ago. Dividends, and they haven't done any share repurchases in the last 3 years, but if they're on sale, this would be a great time for the company to start doing that. Next slide. Now this slide is sponsored by, this is actually the Ring camera from Mark when he was handing out stuff for the kids on Halloween, is that he wanted to be able to show off all his Portillo's hot dogs that he had. So these were gently used. These were ones that he had just given to some of the neighborhood dogs to lick, and he left there for the kids to be able to give. But anyway, with Scuttlebutt, one of the things to take a look at, Phil Fisher talks about this, is try to find out what's going on, because everything about this is looking really good. Why is it beaten down? And comparably is sort of a modern day version of scuttlebutt. Is that you can be able to take a look at seeing what people think of the CEO, and over on the right hand side, indeed, is what do employees, potential employees, or people that are actually working at ResMed think about it. Both of these show me a great indication that this is something that could be pretty good, and there's no red flag showing up, not even a pink flag showing up. Next slide. So here's all my judgments, and this is updated through today. It went up about $10 today, which is about 4%. And you can see I have future sales and earnings at 9 and 10%. You can be able to see, again, I like to look at that section 2. That's all green. That looks great. You know, there's nothing that seems to indicate that there's something the matter with this other than just sort of the rhinos getting all excited about it. And so I have this as a buy up to 167.50. You can compare those metrics with what you see over there on over on Manifest. Now, Manifest didn't update for today when I did this, but I'm really right in that same ballpark. So this is my opportunity. I think I have a shot at winning it because to be able to get this, because I took a stock that Ken always likes to look at, so I have a good shot there, and I kept throwing in a few Portillo references, so maybe that will be enough to get me over the top, and I'll be the winner tonight. Thank you.
Thank you, Kevin. All right, Ken, we're at 9:42, so you'll be.
I'm gonna barrel right through this here, Mark. Okay. I don't know who wrote the investor presentation for Shockwave, but it's one of the best investor presentations that I've read in a long time. I took 7 or 8 slides from that presentation to show you tonight, but it's maybe 35, 40 slides. None of them are really dense, and it gives you just a wonderful, wonderful idea of what the technology does and then where the company is headed. They seem to use as a motto, "We crack calcium," and the company is Shockwave Medical, SWAV. Next slide, Mark. They're looking to transform the treatment of calcified cardiovascular disease. Right now, that's treated by stents and by angioplasty. And they push the calcium around, but they don't really change its structure very much. They're looking to establish a new standard called lithotripsy. I'm not even going to try to say it again, but you can see it spelled out right now there, and it's abbreviated IVL. And they're looking at proprietary local delivery. That means that they have patents that cover what they're doing in this new field to help open up blood vessels that have been calcified due to disease or age. Next slide.
You don't know how much I want to bring some of those people eating hot dogs and put on that slide. Go ahead.
There's an example of a blood vessel that has been calcified, and there's 2 kinds of calcification. There's deep layer calcification and there's superficial calcification. And this new process helps with both of them. It's extremely common the older you get in the population. And again, right now they're being handled by a relatively non-invasive surgery, but they're being handled by stents and by angioplasty. And again, that just pushes the calcium around. It does open the vessel, but it doesn't have staying power. And that's one of the big pluses for this method here. And in addition, this method doesn't involve any cutting. Next slide. It's called cardiovascular lithotripsy. There it is again, okay? But it's just sound waves passing through soft tissue, and it's cracking the calcium and making it easier for the blood to move through. This has been used for years for the elimination of kidney stones, and now they've developed tools and methods where they can use it in blood vessels. Next step. Here's what it looks like. It's a very thin wire that's threaded up to the place where you might have the particular problem. Very, very non-invasive, even compared to putting in a stent or to putting in an angioplasty balloon. An extremely small place to put the very, very thin wire. It goes up to the place, and then these shock waves happen. It doesn't leave you with anything in the body except some calcified, some broken up calcium, and that broken up calcium tends to allow the blood to begin to flow again. Next slide. The total addressable market is $8.5 billion, and you can see the various places in the body where this might have application. Next slide. And right now, it's been approved for Medicare reimbursement, and that's extremely important no matter what the medical device that you're talking about. If it's not approved for Medicare reimbursement, Medicare/Medicaid reimbursement, then it's not going to have a penetration into the market until it is approved. Right now, it's completely approved for hospital inpatient, for hospital outpatient, and then for a number of other things. Notice that in 2024, for example, it'll be approved for physicians' offices where they can do the coronary IVL right in the physician's office. Next slide. There's its headquarters, subsidiaries all over the world. Major headquarters, Santa Clara, 1,200 employees, but a fairly small company. They're making a very small device. They don't need a lot of manufacturing capability, but they do the manufacturing themselves. About 340 employees at the operation itself, plus a pretty deep sales force, and their marketing, they're very proud of the fact that they're marketing products in 60 different countries, and that list of countries keeps growing. They seem to be driven by the need to bring this technology to as many people as they possibly can, and they feel it's their mission because this is such a pervasive kind of problem in human beings generally. And it happens in human beings that have treated their bodies really well, and it happens in human beings that have not treated their bodies really well. It happens to about 70% of the post-60 population. Next slide. It meets unmet clinical needs. The platform has a number of different tools depending on where in the anatomy you're going after the blood vessel. And the pipeline, both of patents and of new tools and procedures, is very, very strong. Next slide. I like to call this an emerging growth company. It's just become newly profitable in 2022. That was the first fiscal year where it turned a profit. It's now turned 2 quarters of profit since then. And Mark and I have observed this pattern on many, many small companies. We note that if the company has not turned around in the next 1.5 years or 2 years and gone back to non-profitability, then it has a wonderful chance of taking off and becoming extremely profitable, especially as the market gurus, the analyst community, especially as they discover the potential of a high growth newcomer on the block, if you will. You can see the 2-year sales estimate from Morningstar is coming in at 37, and they haven't hazarded a guess for a 5-year long-term earnings estimate at this point. I'm using projections from the company. I'm using my own thought process, and I'm trying to be extremely conservative in my SSG and see where that leads me. Next slide. I finally used sales going forward at 25%. I know that makes some of you antsy out in the audience, but that's just not uncommon for a company this size. They won't be able to continue that rate for the next 15 years, but there's a really good possibility that that number is realistic for the next 4 or 5 years. I've set earnings growth at 20%. That's coming to where the company is expecting earnings to grow. They're expecting high teens, low 20s. And I'm going to trust them for the moment. I don't know that much about the management team, but to do my analysis, I'm going to trust that 20. I think that I have the possibility of moving both those numbers to 30 or beyond, depending on how the analyst community views the next 4 or 5 quarters. Notice that pre-tax profit turned positive at 25%. Return on equity is super exceptional in the last year at 58%. And debt, in the history of the company, the debt has been under control and seems to be moving in a downward trajectory from 2021. 3 greens, in other words. Next slide. I chose 35 as a high PE with a 25 growth of sales. I don't think 35 is unreasonable. I choose 20 as a low. That was the low PE in that 1 year of history that we have. So I use that as the basis. It gives me a 4-5 to 1 upside downside and a buy signal. And I would suggest that this might be worth a small investment as a non-core holding. And my hope is that if we sit with it for long enough time, that it will become a core holding. Right now, non-core holding, don't bet the barn. But maybe 1% or 2% of your portfolio is worth it for a company that looks like this. Mark, that's it.
And do we have a question?
I'm sorry. I do have one more slide, and then I'll take the question, Herb, okay?
Okay.
The company does not pay a dividend. I'm getting a 16 to 22% range in par between average PE if I sell it then, or high PE if I sell it then. And that matches really nicely. I would like usually not to look at manifest until the end, and then I use it for validation. And when I get a 16.3 and manifest gets a 16.6, I'm feeling really, really good about my par value. So Herb, what's the question?
Does the broken up calcium cause blood clots?
I would assume the answer is no, because there is all kinds of data in this report on clinical trials. These procedures have gone through extensive clinical trials all over the world, and the trials have been with all men, with mixed populations, and with all women. And it seems to be pretty standard, universally the same, no matter what the sample is. I would urge you, if you have questions like this, to go to that investor presentation and take a look at the clinical data that's sitting right there in the presentation. It doesn't make any mention of anything like that, so I'm assuming that's not a problem, Herb. Anything else? Okay, let's continue then. Mark, are you going to do a song and dance for us? You are, okay.
I got out your little rascals. All right.
All right.
Just again, we started the night with the small companies, just to give you some perspective on how much they have been hammered over the last couple of years. That pumpkin shaded area is the NASDAQ. And you can see that the companies are just really, really getting destroyed by the Magnificent Seven. You can catch that here. So there's got to be opportunity amongst the small and medium-sized companies. One of the things I did, just for kicks, I'm only going to spend a minute on this, just as an example of a way that you can screen for opportunities. I actually found a list of the tickers in the S&P 500. and I injected them into a dashboard. Don't everybody do this at once, or I'll probably get a nasty call from Kurt. But you can actually go in, and I sorted it by growth to look for promising growth companies. On the left there, actually went to a worksheet and threw out the companies that I sorted it by quality and limited it to companies with decent growth rates, and just a way to search for a field of opportunities. Many of the companies we have talked about tonight, including Charlene's Ensign Group, is right on here. Okay, so that's still in the S&P 600. Same thing, just exported it to a spreadsheet where I could look at the numbers. And again, from top to bottom, there are some study opportunities on that list. Ken's Fabrinet's on here. Simulations Plus is on here. Addison we've talked about a little bit. MYR Group was good to us as a infrastructure play, so just an interesting area to go to. But what I'm going to make for my selection tonight, and I know none of you will vote for it, so it's not even in the poll, is an actively managed small cap fund that takes the S&P 600 and actively selects higher quality, higher growth rate opportunities from it. Same thing, ran it through a dashboard and basically put $100 into each one just so I could look at the characteristics of the portfolio. You'll notice that the quality's a little higher, the growth rate's a little higher, and the par is okay too. This one's kind of interesting. A company that you might want to run up the flagpole. Marie Frank has been talking about AI and cybersecurity on the forum, and I think this company recently added to Value Line's standard edition might be an interesting one to put on the radar screen. So with that, Ken, I'm going to go ahead and add my $1,000 to MMSC, which is a First Trust exchange traded fund. So we can kind of track the good small companies going forward.
And I'm going to get us to a poll here. That's not the poll I want. I'm sorry. Hold that. I think this is the poll. No, that's not it either. There it is. And let's launch this poll. And we'd like you to choose, folks, between Ensign Group, that was Charlene Stock, Globus Medical, that was from Cy Lynch, ResMed from Kevin Galogli. I'll get that correct, Kevin.
You got it. You got it. There you go.
Myself. Okay. If you don't like any of them, let's choose none of the above. We're up to 60% voting. We'd love to have as many possible voting as possible as we can. 3/4 voting now.
This is a really close race.
Up to 80%. I'm going to kind of count to 10 backwards in my mind and then close the voting. Let's see if you can push it to 90%, folks. Give us a help out here. Okay, and I'm going to close and share. And it looks like we're going to put a position in Shockwave, an extra position in Shockwave, Mark.
Yep, that was close though. That's as distributed as we've seen in quite some time. Of course, if I had brought my ETF, you guys would have all been completely decimated.
Would have been 85 for you, right? Okay.
Go back into your gently used hot dogs, okay?
So let's continue. Do we have any more slides for this evening, Mark?
Yeah, just real quickly, just a reminder for the audience that we do archive these presentations. I'll break this one up into the small company portion of the presentation and the roundtable, and it'll be available here fairly soon. And Ken and I will be in New Orleans this weekend. If you want to stop by New Orleans for an investing day on Saturday. And we do have a number of events, including a stock picking festival for Mid-Michigan that I believe is open to attendance nationwide. You can get...
Absolutely. You can register on the Manifest Investing website or on the Mid-Michigan page on the Better Investing website. It's November 8th, a week from tonight. We're going to talk about our stock pickers contest for a little bit of time, and then we're going to move into a class, and it's going to be kind of bits and pieces about a lot of different things, maybe kind of similar to what we do in a bull session.
Sounds good. Of course, the November roundtable is right after Thanksgiving, so everybody have a happy Thanksgiving. And I think that's it, Ken.
I want you to save the dates, folks. January 3rd and 4th, we'll be running a series of classes. The overall umbrella title is called Getting Started, and we'd love to have folks that consider themselves beginners or that would like to kind of review some of the most basic things about investing, or just enjoy coming to investing events. April 10th and 11th, we're going to be doing our 5th Successful Investing Conference, and we'll have a series of classes there to be on general topics, and we'll be getting more information out to our chapter and to our guest lists as those dates begin to approach. We're hoping that we can attract audiences similar to what we did during the pandemic. But if not, we'll be happy to be speaking to whoever chooses to come. Again, save the dates now, and we'll have the information coming out to you in a timely fashion. Mark, maybe we should close this down, and then we do have a few questions that we can try to get answered.
Yeah, I would just like to thank Charlene and Cy and Kevin. Kevin has raised our hot dog hunger threshold once again. So again, thanks for the contributions, guys.
Okay, I have one hand in the air, and it's Kate Smith, and